Hello, dividend growth stock investors. It's Colby, the DGI crab, coming to you with an answer to another question sent to me via email. I love making content based on answers sent to me by viewers. I really appreciate you taking the time to email me at dgicrab@yahoo.com with any questions you might have about dividend growth stock investing, a particular stock or ETF, or any type of investing topic in general that I feel like I can speak to. So this is a question from a viewer that I'm going to provide a video response to. I'll always email you back, but if I feel like the question deserves a bit of a longer or more detailed answer, I will go ahead and make a video for it as well so everyone in the DGI Crab community can benefit from it. I'll keep you anonymous, so don't worry about that. But I definitely appreciate your questions. Keep them coming because this is my favorite kind of content to make. Before I go any further, I will say I'm not a licensed professional, so just keep that in mind. You should always do your own due diligence before you invest in anything. So this is kind of a two-part question. The viewer asks, for your 4-tier brackets, why is Target, stock ticker TGT, not a fit for tier 1? Now, for anyone who's new, if you're here for the first time, you'll know that you might not know, I've constructed this channel around 60 dividend growth stocks, and I've divided those into 4 different categories, tiers 1 through 4. Tier 1 is your 18 to 30-year-old investors. These are faster growing dividend compounders. Tier 4 is your 54 and up investors who are going to be more in need of immediate high yield when they're adding to their positions. So why is Target not a fit for tier 1? So I have Target in tier 2, which is for the 31 to 41-year-old investors. So we'll get to that in a moment. The second part of the question is, why is tier 4 all TFs and no dividend stocks? Or is the strategy tier 1, 2, and 3 roll up over the years to the older tiers, and once you hit 54 plus, you stop adding stocks, keep what you have, and add new money into ETFs? Well, not quite. Not quite. So there are dividend stocks in tier 4. Now, of the 60 stocks in total, only 10 of those stocks are part of tier 4. That's the smallest group of the tiers. The reason that's the smallest group of the tiers primarily is because dividend growth is the primary factor I was looking for, the growth history of each of the companies. And for stocks where you're starting with a very high dividend yield, it's a real challenge to find stocks that not only have a long track record of increasing the dividends and not just basically being yield traps. That I really only found 10 that I felt were appropriate for that age range. So let's take a quick look here at the spreadsheet and target stock. So first of all, for target stock, if we just take a look at it here on Seeking Alpha, and we look at the dividends tab, just to get an idea of the history, we could see that Target currently is yielding 3.11%. It has a nice payout ratio of 49%. I absolutely love it when the payout ratio is as close to 50% as possible. It's a perfect balance of rewarding shareholders with dividends while also still continuing to invest back into the company for growth. There's a 5-year growth rate of 11.44%, which is excellent. And even more excellent is their history of 55 consecutive years of growing the dividend, which makes Target a dividend king. Including Target in the 60 stocks that the channel zeroes in on was an absolute no-brainer. So we're going to pull up the spreadsheet here. This is the spreadsheet where I have separated out the tiers and track all of these stocks individually. We primarily focus on the valuation metric, which is taking the 4-year average yield and comparing it to the current day yield and determining how undervalued that stock appears to be at the current time. Now, Target, as you'll see here, is in the tier 2. And primarily the reason for why it was placed in the tier 2 group of stocks, which is the largest group, there's 19 stocks in this group, is if we look down here, what we're wanting to look for here is in this age group, you probably want to start acquiring yield of at least a 2% starting yield. Hopefully more in the mid to high twos, because when you're buying any of these stocks, you're going to be buying them when they are at least 20% higher yield at the time you purchase them as compared to where they are in the 4-year average. So like Target right now would be in the buy zone. It's yielding 39.5% higher right now than it has over the past 4 years on average. So this looks like a good buying opportunity in my estimation. So even though the 4-year average yield is just 2.22, you can get it right now at 3.1, which is going to give you a really nice starting yield. And what we want to get in this age range is a dividend growth rate in the high single digits, so at least 7%. And if we can get that all the way up to like 9.5%, 10%, so much the better. So as we compare the 2023 increases of all of these 19 stocks, the average increase last year was about 7.88%. Some did better, some did worse. Target was 10.1%. Really nice, definitely on the higher end of that. So I understand where this question comes from. Well, why is this not a good stock for tier 1? You've got that double-digit dividend growth rate. If we look over here at the tier 1 grouping of stocks, we're going to be, for this younger group of investors, it's okay to acquire stuff that's yielding in the low ones, mid ones, high ones. Some of these stocks, like Visa, for example, you may never be able to buy Visa yielding higher than 1% unless they have some serious bad news that they run into that drives their stock price way down for a while. But what we want to do with this group cumulatively is we're getting, we're getting a starting yield, in the mid ones, let's say, cumulatively. But we're looking for an annual dividend growth rate well above 10%, hopefully more in that 12% or higher range. Now, Target's been pretty close to that, and it also has a much higher starting yield than these stocks here on the tier 1. But I just simply anticipate the growth rate on this grouping of 16 stocks to consistently be a little bit better than the Target growth rate. Because Target, depending on what's going on in the market, sometimes we've seen just over the last 5 years, they'll increase that dividend like by 20%. And then lately it's been a little bit slower than that, and I'm not anticipating any big 20% increases out of them anytime soon. It's not to say that I think they're in trouble, but I think that that 5-year growth rate might progress a little bit back to the mean just a little. That's just a guess. But because the growth rate is in double-digit percentages recently, it could be a nice candidate for tier 1. But my general recommendation following the tier plan is that you stick within your own tiers, for one, because it's enough individual stocks to focus on. There's generally going to be a value somewhere in the tier for you to add to. But if there is a stock in an individual tier that looks to be 50% or more undervalued, then at that point, the floodgates are open, and if you want to add it, regardless of what tier you're in, you can go ahead and do so, and I think it would be a fine idea. Target's getting there, but it would have to be even lower than that. We'd have to be down in like the low 130s or maybe 120s before I'd think a tier 1 person would have a good reason to jump up and get it. Because one thing to remember, if a stock is really down in the dumps for a while, sometimes that might be a year where they grow the dividend a little slower than they typically do, just because they may be playing it a little conservative and make sure that they're not getting out, too far over their skis. And Target, I would assume, is going to do everything they can to keep that 55-year growth streak intact and continue to add to it. Now, for the second question regarding the tier 4 investors, if we hop over to this part of the spreadsheet, so these are the 10 stocks that I've got here for the tier 4. It's not all ETFs, it's just a smaller grouping of stocks. Verizon, Realty Income, Main Street Capital, NNN REIT, Essex Properties, Aris Capital, Altria, Prudential, Con Ed, and One Oak. Now, Lately, really the entire time since I started the channel back in mid-June, there just has not been a fantastic buying opportunity for any of these individual ones. Realty Income in the low $50 range certainly looked pretty appealing back in June, but there just has not been any real undervaluation with any of these. Now, if you go back and look at the history of like the last 3 or 4 years, there have been wonderful buying opportunities for all of these stocks at one point or another. But the theme of the channel is we're adding stuff when it looks like it's on sale. Investing in individual companies, single stocks, is inherently more risky than investing in ETFs. So if I'm going to take the risk of adding my hard-earned money to an individual stock, I want to get it at an absolute bargain basement price because I'm getting a higher starting yield when I do that. And I'm also giving myself more of an opportunity for price appreciation because I'm hoping that I can be part of the stock's recovery. So that's sort of the theme there. Now, on my Friday videos, when we go over all of this and we take a look at the strategy for the investors for the week, my general recommendation is that regardless of the tier you're in, when you're making your investment for the week or for the month or however frequently you invest, you contribute half of it at least to ETFs. So you have the automatic diversification in your portfolio that the ETFs will provide. And these are age based, so these ETFs sort of line up with the expected dividend yield and growth rate that we want with the single stocks. But with tier 4, since they have the smallest group of single stocks, which is 10 compared to the other 3 tiers, they have, by a factor of 2, the most ETFs in their given tier. And the reason for that is there are a lot of high yielding instruments that I do not include in any of the other tiers. So, for example, I don't have any MLPs, Master Limited Partnerships, in any of the other tiers. I like just saving my MLP exposure for when I'm older because they're higher yielding, and this ETF is a lot more tax friendly. And covered call ETFs, I don't recommend anyone get into those unless they're already well into their 50s and they're looking to add high yield quickly. My 2 favorites are Devo and Jeppy. They have long track records. They've been very successful ETFs. There are some other covered call themed ETFs that look kind of appealing that I'm keeping my eye on, but for now I'm going with the ones that we know the most about that have really proven track records up to this point. So this is a very diversified portfolio for the tier 4 investors where they're getting 20% into stocks still with DHS and SPYD, and then they're getting themselves a little bit of exposure to the higher yielding stuff in alternative categories like high yield bonds, preferred shares, MLPs, covered calls. So that is the breakdown, and I hope that that answers your question very thoroughly. I am, again, always happy to answer any viewer's questions because the way I see it is if one viewer has a question and needs some clarification on a point, there's probably a few other ones that also could use that clarification as well. So keep them coming, everybody. I have links in the description below to a video on each of the individual 4 tiers where I break down all of the companies individually and explain, briefly on each of them why they made the final cut for the 60 stocks that the channel focuses in on. And I'll also link a video explaining the breakdown on these ETFs down there as well, so you can get some understanding as to why I have broken down these ETFs in this way based on the age tiers. Questions, once again, can be sent to dgicrab@yahoo.com. I will always respond with an email, and maybe just maybe I'll do a video response as well. Keep them coming, everybody. Keep investing.